Silver crashed 50%. The real shortage story is just beginning. Silver just did something it has only done a handful of times in modern history. It fell nearly 50% from its 2026 peak in a matter of months, and almost nobody outside the metals market noticed. While everyone was watching stocks, watching Bitcoin, watching the headlines about tariffs and elections, silver quietly collapsed from over $120 an ounce down to under $59. A crash that size, in an asset this important to the global economy, should have been front-page news. It wasn't. And now, just as fast as it fell, it's snapping back. Quick question before we go further. If you had $10,000 right now, would you put it into silver after a crash like this? Or would you stay away until the dust settles completely? Drop your answer in the comments. I read every one of them. By the end of this video, you're going to understand exactly why silver cratered, why the Federal Reserve's own words may have triggered part of the move, and why a new exchange opening on the other side of the world might be quietly exposing a shortage that Wall Street has been papering over for years. Stay with me, because the final piece of the story connects everything. Let's rewind. Earlier this year, silver was trading north of $120 an ounce, one of the strongest runs the metal has ever had. Investors who bought early were sitting on extraordinary gains. Then, over the following months, the floor gave way. By late June, silver had fallen to its lowest level in 7 months, dipping into the $58 range. Most retail investors saw that chart and panicked. But here's where it gets strange. The same forces that pushed silver down were about to reverse, almost overnight. Pause for a second. Think about how fast that happened. A metal doesn't lose half its value and then rebound within weeks, unless something structural is going on underneath the surface. This isn't normal volatility. This is a market fighting itself. Here's what most people missed. Fed Chair Kevin Warsh had been signaling a harder line on interest rates, and that hawkish tone was part of what crushed silver in the first place. Higher rates make non-yielding assets like silver and gold less attractive because investors can just park money in bonds and earn a guaranteed return instead. But then something unexpected happened. The June jobs report came in at just 57,000 new jobs, the weakest reading in 4 months, and far below the roughly 110,000 economists expected. Unemployment ticked in at 4.2%. Wage growth crept up, and suddenly the market's entire expectation for the Fed flipped. Before that report, traders were pricing in roughly a 2/3 chance of another rate hike in September. After it, that probability was cut to somewhere near 50%, almost overnight. And this next part may be the most important. Warsh himself, speaking at the ECB's forum in Sintra, Portugal, said inflation risks have come down. That single comment, paired with the weak jobs data, sent the dollar sliding toward its biggest weekly drop since April. A weaker dollar means precious metals suddenly look a lot more attractive again. Silver responded almost immediately, ripping back above $60, then above $62 an ounce. But before we continue, there's something important that almost nobody is talking about. This entire story so far is just the paper market. What's happening in the physical market is a completely different and much stranger situation. If you're enjoying this deep dive, hit the like button. It genuinely helps more people find this kind of analysis. And if you like understanding what's happening beneath the headlines, instead of just reacting to price swings, consider subscribing. This channel is built for investors who want to think differently about markets. For decades, the silver price you see quoted on your phone has been set almost entirely by paper contracts on COMEX in New York. Contracts representing 5,000 ounces of silver that, in the vast majority of cases, are never actually delivered. They're bought, sold, and settled in cash. The actual metal barely moves. Most investors stop their research right here. They assume the quoted price reflects real supply and demand for physical metal. It doesn't, not entirely. It reflects the balance of paper bets, layered on top of a much smaller pool of actual, deliverable silver. Now here's where it gets interesting. In May of this year, the ABAX exchange in Singapore launched something called the Silver Singapore Futures Contract. Unlike most COMEX contracts, this one is physically deliverable. 1,000 troy ounces of 99.99% pure silver delivered into vaults in Singapore, including Brinks, at a purity level specifically demanded by solar panel manufacturers, semiconductor fabs, and advanced electronics producers across Asia. Think about what that means. This isn't a paper casino. This is a contract designed for companies who actually need the metal in their hands to build things. Would you have expected a brand new exchange in Singapore to matter more to the real price of silver than New York? Most people wouldn't, but that's exactly why this signal is so easy to miss and so important once you see it. Silver isn't just a monetary metal like gold. It's an industrial one. It goes into solar panels, into electric vehicles, into the servers and infrastructure powering the AI boom. Every one of those industries has been scaling up demand for physical silver at the exact same time mine production has struggled to keep pace. That's created a structural deficit, a gap between how much new silver the world needs and how much is actually being mined every year. And that gap doesn't get closed by a futures contract settling in cash. It only gets closed by real metal moving out of vaults. The gold to silver ratio, a simple measure of how many ounces of silver it takes to buy 1 ounce of gold, recently compressed to around 66.5. Historically, when that ratio tightens like this while physical demand is accelerating, it's often a sign that silver is starting to catch up to gold, not the other way around. What I'm about to connect here may completely change how you think about this entire market. So let's put the pieces together. A hawkish Fed helped crush silver down to 7-month lows. A single-week jobs report and a few words from Kevin Warsh flipped rate expectations and sent the dollar lower, sparking a sharp rebound. And underneath all of that noise, a new physically backed exchange in Singapore is quietly exposing just how thin the real, deliverable supply of silver actually is. At the exact moment industrial demand from solar, EVs, and AI infrastructure keeps climbing. Historically, this tends to happen. Paper markets set the price everyone sees. Physical markets eventually force a reckoning when the two drift too far apart. If this trend continues, the pressure doesn't get released through commentary or forecasts. It gets released through delivery. And this final signal may be the piece that connects everything. So this isn't simply about a 50% crash and a sharp recovery. This isn't just another volatile month for a volatile metal. This may be telling us something much bigger about where the global economy is heading. A Federal Reserve caught between a weakening labor market and lingering inflation, a dollar losing some of its grip, and a physical silver market that's getting quietly stress tested by a new exchange most investors have never even heard of. So here's the question. Was this crash and rebound just another emotional swing in a notoriously volatile market? Or is silver in the early stages of repricing around a physical shortage that paper markets have been hiding for years? What happens next could shape this market for months, maybe longer. If you made it this far, you're already doing more homework than most investors ever will. I'd genuinely love to hear what you think, so drop a comment below. If you enjoy deep dives like this into what's really moving gold and silver, subscribe and turn on notifications, because the next few months in this market could get very interesting. Because sometimes the biggest opportunities show up long before the crowd even notices something has changed.